Good afternoon. We start sharp at 2 o'clock so that we can finish before. I would like to start at 2 o'clock sharp. Alberto, secondo te qual è il problema? Ma prima vedevate? Sì. Okay, I try again. Good afternoon. We start at 2 o'clock sharp so that we can finish some minutes before 5 o'clock. And if you have any questions also about your analysis, I'm here. Alberto just told me that this morning you asked you a lot of things, and this is good. This is the right approach. I'm sure that it is impossible to understand everything of these financial statements that are financial statements of very large companies with a lot of peculiarities and issues. So it is quite normal not to be able to understand everything when you read for the first time this financial statement. Emanuele asked me in the chat something about the presentation. Every member has to present. Then it doesn't matter if exactly the time is the same for everybody. This is not important. But we would like to listen every member. Okay? Then I kindly remind you that you will have 10 minutes and then some minutes of discussion. So it is very, very, very important to choose the topics that you want to present. You will be, your presentation, when we will grade your presentation, we will take into account your capability of choosing the most significant issues for your financial statements. The layout, the graphic of the presentation, how you present then in practice the case, the financial statements, and also the capability of answering to our questions. Okay? So we will put everything together, and the final result will be the grade. As you can imagine, our goal is not to give the minimum mark for this type of activity, but we cannot, in the meantime, we cannot also give the maximum that is 30 to everybody. We need to make some distinction, and so the distinction is made according to your capability of choosing the right topic, your capability to make a presentation that is a good presentation to be from a layout point of view, your capability to present in 10 minutes, and so you have to, it is very important to use the 10 minutes, but not to use more than 10 minutes. Okay, so you must stay between 9 and 10, because suppose you are a consultant, you have a meeting with a client, the client allows you 10 minutes, it is not a good idea neither to use only 5 minutes, because if you have 10 minutes and you are at the client premises, you have to use all the time that the client allows you. And on the other hand, if you have 10 minutes, it's not a good idea to use 15 minutes, because the client allows you a slot of 10 minutes. Okay? These are the main indications. Okay. Now, I share with you an Excel file. This is the exercise that we started yesterday about the rebates. If you remember, the car maker allows the dealer, the car maker enters into an agreement with the dealer for selling cars at 20,000 euros each, but with a rebate of 2% if during 2021 the dealer buys at least 50 cars. Yesterday we analyzed the contract according to the 5 steps, and we realized that the critical step is the number 3, the determination of the transaction price, because the transaction price is variable due to the rebate. Yesterday we discussed the scenario A, that is the car maker on January the 3rd, that is the date of the sale, estimates probable to be obliged to pay the rebate. And so yesterday we made the accounting entries on January and at the end of 2021. In the scenario A1, the estimate was confirmed. And in this case, only in January, February 2022, the car maker pays the amount due. But the liability for rebates is still there. and so it is sufficient to pay. The scenario AB, the estimate is not confirmed. So the car maker doesn't pay anything because the dealer haven't reached the 50 cars that is the threshold in order to have the rebate. In this case, yesterday we saw that the liability must be recognized, must be closed, because if the company doesn't have any obligation, it doesn't make sense to maintain the liability. But in this case, we don't have an outflow of cash. This is a change in an estimate. Yesterday, I told you, not yesterday, but today, okay? I told you that when there is a change in an estimate, the gain or the loss, the revenue or the cost, must be recognized in the income statement in the same items, in the same line that was affected originally by the estimate. In this case, the revenue. So in this case, this means that the revenue is increased by 1,600. Here you can see the situation in the scenario B, that is the car maker estimates not probable when the sale is done, that is on January the 3rd. The car maker estimates not probable to pay the rebate. So the revenue is recognized for 80,000, the full amount. Then, during 2021, the dealer purchased less than 50 cars. This means that our estimate is confirmed. We don't have to do anything else, because revenue will recognize for 80,000. The trade receivable, of course, is collected after 2 months, and we don't have to do anything else. Scenario B2, during 2021, the dealer has bought more than 50 cars, so the rebate must be paid, but in this case, in our balance sheet, the liability is not present. So we need to reduce the revenue, and we need to recognize the liability for rebates or the contract liability that is the same for 1,600. Then in January-February 2022, the rebate is paid, and so the liability for rebates is eliminated, and an outflow of cash for the same amount is recognized. Is this clear for everybody? Any questions? Yes.
Professor, this is the scenario for the first scenario, just the last part.
Okay. This is the second scenario, so that is the car maker estimates not probable to pay the rebate.
Okay.
So this means that on January the 3rd, that is when the sale occurs, at the date of the sale, the revenue is recognized for the full amount.
Okay. Okay.
Then, scenario B, 2 possible conclusions.
Yeah.
B1, our estimate is confirmed. no rebates. B2, our estimate is not confirmed, so the company has to pay the rebates, but the rebates was not recognized at the beginning.
Okay.
So this means that first we need to recognize the liability for the rebate and the reduction of revenue. And second, in January, February, we have to pay the rebate. Okay? This evening I will upload this file and I will provide also the income statement and the balance sheet, even if here you have all the information in order to prepare the income statement and balance sheet in the scenario A1, A2, B1, and B2. Okay? Now, another example, a different situation, but at the end the mechanism is exactly the same. Here our problem is that of return rights. Return rights, suppose when you buy something online, for example, you have the right to return the product even if there are no problems in the product, simply because you don't like it. Do you agree? Is this clear? So you buy, I don't know, whatever, through Amazon or Zalando or whatever, you buy something, you pay, you obtain, you collect your product, you look at the product, even if the product is exactly the one that you have ordered. It is perfect, no defects, but simply you don't like it. Okay? So you have some days, generally speaking 14, 15 days, in order to return the product. Okay? This is called the return rights. Okay? I repeat again, not because the product has some problems, not because the product is different compared to the product that you have ordered, but simply because you don't like it. For our exercise, just to simplify the exercise, we suppose that the period that our company allows the customer in order to return back the products is 1 month. Okay? Generally speaking, repeat, it is less than 1 month. 14, 15 days is the regular period for the return right. So suppose that a company in December year 1 makes some sales of some products. So the sales are sales of product A. Suppose that, I don't know, 1,000 units of these products are sold. Whatever you want, bags or laptop or whatever. We need to know the price. Suppose 100 euros each unit. Okay? So in December, the company sells 1,000 units of the product A at 100 euros each. And suppose that the company collects everything. Think about an online sale. If you don't pay, the product is not delivered. Okay, so you pay, you as a customer you pay, the company collects the money, but the customer has 1 month in order to exercise its return right. Based on its experience, the company expects that 10% of the customer will exercise the return right. Okay. So return right rate 10%. Do you have any idea on how to account for this transaction? Keep in mind, when you try to solve an exercise linked to revenue recognition, try to follow the 5 steps. Okay? So, step 1. Do you remember the step 1? Step 1 is
identification of the
identification of the contract, as also Erika has written. No particular issues here, okay? Of course, there are probably 1,000 contracts in December, but they are all similar, but there are 1,000 contracts. Step 2, do you remember step 2?
Performance obligation.
Identification of the performance obligation in the contract. Again, no particular issues because here we have just one performance obligation that is the sale of the product A. Okay? Step 3, determination of the transaction price. According to IFRS 15, when there is a return right, it's like having a variable price. Okay? So the sale is recognized, but since there is a return right, it's like having a variable price. So the presence of a return right is the same as variable price. So this means that the company must recognize revenue, but it is not possible to recognize a revenue for the amount collected, because according to the experience, the company expects to be obliged to pay back the 10% of the sale. When the sales are recognized, the company doesn't know if it is the customer B, the customer C, if it is Mr. Red or I don't know, another customer. But based on its experience, the company expects to be obliged to pay back 10% of the amount collected. Step 4 doesn't matter. And step 5, this is the recognition of the sale at the point in time or over time? at the point in time, because this is not a service, it's not the construction of an asset, so at a point in time. And generally speaking, this is, I hope you remember that this is when the control is transferred to the customer. And this could happen when the product is shipped, more often when the customer collects in his or her hands the product. Because in most of the cases, the risk of the shipping risk from when the product is shipped, for the transportation, until the product is delivered to the customer house, in most of the cases these risks are borne by the company. Okay? So generally speaking, the control is transferred when the product is delivered to customer's house. Okay? We suppose that all the sales done in December of all the products are delivered to them by the end of December. Okay? So, in December, year one, the company has to recognize the revenue. What about the accounting entry? Taking into account what we have just discussed.
Fixed variable.
We need to recognize the revenue, the sales. I suggest you to start always from
Cash.
trade receivable or cash because it is easier. In this case, it's up to you. You can recognize first a trade receivable and then immediately the inflow cash because this type of sales is immediately collected. So the trade receivable, that is the amount collected, is the whole amount. So 1,000 units multiplied by 100 euros. Okay? This is the amount collected. We first use trade receivable and then immediately it is immediate. The collection is immediate. What about the revenue? How much is the revenue to be recognized?
90% of the total of trade receivable.
Exactly. The mechanism is the same as for rebate. Since the company knows, estimates to be more precise, that some 10% of the customers will exercise the right of returning the product, we cannot recognize the whole amount as a revenue, but only the 90% of the revenue. The remaining part, that is of course the 10%, cannot be recognized as a revenue but as
Liability.
a contract liability. So as you can see, once having understood the mechanism of variable price, the accounting entries and the accounting treatment is always the same. The difficult part, of course, is the estimate of the 10%. Okay, so contract liability, in this case for return rights. The trade receivables are immediately collected. So 100,000. So the revenue in the income statement of year 1 is 90,000. In January, year 2, again, 3 possible scenarios, but the mechanism is always the same. The first scenario, the estimate is confirmed. So what about the accounting entry if the estimate is confirmed? So confirmed means that 10% of the customer exercise the return right, so the company is obliged to pay back the 10% of its revenue. So what about the accounting entry?
The bank account we need to deduct the 10% from the bank account that we received.
So we need to pay.
Yes.
So we have an outflow of cash, exactly of 10,000. Credit side, 10,000. And
Liability reduction.
exactly, if we pay, our obligation is expiring, so we need to eliminate the contract liability. Is this clear? So, in year 1, we have revenue for 90,000 in the income statement and the contract liability for 10,000 in the balance sheet. In year 2, if everything is confirmed, the company has to pay, and the contract liability, of course, is eliminated. Okay? But scenario B, the return rights are 15% of sale. So higher than estimated. Higher than the amount originally estimated. So, how much is the outflow of cash? How much is the outflow of cash?
5,000.
15% of the sales. Okay, so 15,000. But 10,000 it's the amount originally estimated. So we de-recognize the contract liability for the original amount. Of course, 5,000 are missing. 5,000 are missing. What is the account we used? Revenue, sales, or the same account used here. This is again a change in estimate, so we need to use the same account used for the original estimate. Is this clear? And if you want, I can do also the scenario C, but the mechanism is always the same. So the scenario C, return rates are only 8% of sales. Mechanism is the same. The outflow of cash is 8%. So 8,000. But the contract liability must be eliminated for the full amount, that is 10,000. In this case, there is a positive difference of 2,000. At the end of year one, we overestimated the return on rights, so we underestimated the amount of the revenue. Now the revenue are increased for 2,000. Is this clear for everybody? Any questions? And this is the mechanism that must be always used when the price is variable. If everything is clear, I would like to add only one little thing. These are the slides that we discussed last Tuesday about revenue recognition. And this is the beginning, okay? I would like to highlight the fact that in the income statement we have sales for 14 euros, that was the price for each product, multiplied by 25 products sold. And please look at the cost of goods sold. 10 euros, that was the cost, but please focus on the number of units, 25. I repeat again. There must be a link, a relationship between sales and cost of goods sold. Okay? If the company sells 25 units, okay, the revenue is affected by the price of 25 units, and also in the cost we must find the cost of 25 units. The remaining 5 units that were not sold, they are in the inventory. Is this clear? We discussed this yesterday, and yesterday you got this. Tuesday, and you told me that it was clear. Now, having this in mind, that is, there is a matching between sales and cost of goods sold. Now, have a look at our situation. If we look at our warehouse at the end of December, The products are not there because 1,000 units of products are at the customers' houses. The company does not have the physical possession of 1,000 units. Do you agree with me? They are not in the warehouse of the company because these products are in the customer's hands. But from an accounting point of view, since the return rate is 10%, this means that we expect to be obliged to collect back 100 units of the product A. Do you agree with me? In fact, if we draw up the income statement, balance sheet, income statement, revenue are equal to, 90,000, okay? And 90,000 is equal to 90% of the product sold multiplied by 100 euros. That is the price. You agree? So, what do you expect to find in the cost of sales?
$90.
The cost of only 900 products, because there must be a correlation and matching between revenue and cost. If within the revenue we recognize the revenue only of 900 products, okay, because this means at the end that we have recognized as sales 900 products multiplied by, of course, the selling price. Okay? The same for the cost. Here we need to find the cost of only 900 products A. Okay? Multiplied by the cost. We don't know how much is the cost of this type of products. Is this clear? And what about the remaining 100 products?
Inventory.
Exactly. They are in the inventory. Okay? So in the inventory, we need to recognize 100 products. They are not physically in our warehouse at the end of the reporting period because they are at the customers' houses. But from an accounting point of view, they are not sold. And if they are not sold, they are still in the inventory. So 100 products A multiplied by the individual cost, right? The cost for each unit. And this is as at the end of year 1. Of course, in year 1, in the liability, we have also the contract liability that is 10,000. Is this clear for everybody? This is very important because this means that the inventory in the balance sheet depends on the sales. This means that most of the cases, the amount that we read in the balance sheet correspond to products that are still in the warehouse of the company. But, like in this case, even if the company does not have the physical possession of these products, from an accounting point of view, these products are not sold. And if they are not sold, they must be maintained in the balance sheet as inventories. Is everything clear for that? Okay. Any questions?
The contract liability is on the asset side in the end.
The contract liability is not in the asset side, is in the liability side, but if you prefer, I can do this. Okay, so in this way it is clearer, maybe.
But we have paid back already, so shouldn't it be eliminated?
No, this is the balance sheet at the end of year 1, and we pay back only in January, February of year 2.
Okay.
So the liability is 0, but only in year 2.
Okay.
In year 1, it's still there. Okay? This is year 1. Any questions? Okay. Other important point. Suppose that you sell something and you allow your customer to pay in 2 years. So the date of the sale occurs on, just to simplify, at the beginning of year 1. But, and suppose that the amount invoiced, suppose is 100,000 euros. Okay? The customer will pay in 2 years. Okay? So we allow our customer to pay with a delay of 2 years. As you can imagine, this is not so common. Because this means that company is acting as a bank. For the customer, this is a very good transaction, but it is not for the company. In fact, in this case, 2 possible situations. The company can decide to manage this type of agreement in 2 different ways. First scenario, I tell the customer, okay, I allow you to pay in 2 years, that's good, but you have to pay an interest. So in this case, there is an explicit interest rate. This means that the company agrees on the customer's request to pay in 2 years. But since 2 years is a very long period of time, and our company is not a bank, the company asks the customer to pay an interest. For example, a 3% per year. Okay? So an interest 3% annually paid in arrears, that is at the end of December. Is this clear for everybody? This is the easy case because the company recognizes a trade receivable. Sorry, I put also the date. Oh. Okay. A trade receivable and revenue. Again, here the critical point that is the step 3, the determination of the transaction price. But in our particular case, it's not a problem. Why? Because the interest rate is paid explicitly. So this means that we recognize our revenue in the right side, 100, and there is a receivable for the same amount. Then, at the end of December, our customer pays the 3%. So the company collects the 3%, and the 3% of the amount of the receivable means 3,000 euros immediately collected. What about the account that the company has to use in the credit side? Revenue. This is a revenue, that's true, but if we use only revenue, it's sales of products, providing, service providing, and so on. This is a very particular type of revenue. Interest income. Okay, so interest income. The same at the end of year 2. The customer pays another 3% plus the amount due. You can make just one double entry record or 2 double entry records, it's up to you. What is important is that on the one hand, there is an interest income collected of 3,000, and always at the end of December, the company collects also the trade receivable for 100. Is this clear for everybody? This is the easiest scenario because the company explicitly obtains an interest for the delay. Suppose you are the sale manager. You want to increase the sales. If you go to the customer and if you say to the customer, I allow you to pay in 2 years, but you have to pay an interest rate of 3%. Probably the customer is not so, doesn't appreciate so much this proposal. Probably for the sale manager, it's better to make another type of proposal to the customer. You pay 2 million in 2 years. or maybe not 2 millions, but 2 millions and something in 2 years without any explicit interest rate. Probably the customer is more interested in this type of agreement. Okay? So the scenario B, no explicit interest rate. We try to solve the exercise in the hypothesis that the amount invoiced is always 100 euros. Of course, in this case, it is a big mistake for the company to allow the customer to pay 2 years 100 euros if the company doesn't require an explicit interest rate. It's a big mistake because at the end, this means that the company is acting as a bank, and part of the amount that will be collected is not for the sale of the revenue, but it's for financing the customer. I repeat again. If we suppose that the amount invoiced is always the same, 100,000. Okay, so we say to the customer, do not worry, you pay 100 but in 2 years. Okay? In this case, according to IFRS 15, within 100, there is a so-called significant financing component. Why? Because the delay is more than 1 year. So when the delay is more than 1 year, according to IFRS 15, there is a significant financing component. If you ask for an explicit interest rate, it doesn't matter because you are remunerated for this transaction. You are remunerated in order to finance the customer. But if the interest rate is not explicit, according to IFRS 15, this amount must be split into 2 parts. Because that's true, you will collect 100,000 euros in 2 years. But this is not only for the sale. This is for 2 reasons. Okay? So, the amount to be collected in 2 years, that is 100,000 euros, is for 2 reasons. The first one, for the sale of, I don't remember what, the sale of the product, and for financing the customer. It doesn't matter the fact that you don't explicitly ask for an interest rate. Form, no interest is required. Substance, if you are allowed to pay 2 years, you are financing. And so you need to determine how much of the amount that will be collected is for financing the customer. This is very important because the sale of product is accounted for according to IFRS 15, and in our case, the revenue is recognized at a point in time. That is on January the second year one. The financing component is an interest income. Here the standard is another standard. It is the IFRS 9 dedicated to financial interest. And even if you don't know now anything about IFRS 9, I'm sure that you know that an interest is always recognized over time because it's linked to the timing. So the interest must be recognized over time, so split over 2 years. Is this clear for everybody? Now, any idea on how to split 100,000 into the two components? This is a question also for students that are at home. Any idea on how to split 100,000 into the two parts? Any ideas? I try to use we are here 1st of January year 1. The amount is the company expect to collect the amount at the end of December year 2. We expect to collect here 100,000. It's very difficult to write it this way. My computer is a touchscreen computer, so it is easiest. With the mouse, it's a little bit more complex. So, any idea? Now, I hope that with this graph, someone could have an idea. We expect to collect 100,000 in 2 years. 1 euro tomorrow is worse than 1 euro today. So this means that if we use the same interest rate that we used in the previous case, 3%, we need to compute the present value of the future amount today. This is the revenue. The remaining part is for the interest. I repeat again. 1 euro tomorrow is worse than 1 euro today. So if I expect to collect 100,000 tomorrow is in 2 years, I cannot recognize a revenue for 100,000 euros. The revenue is equal to the present value of the future payments. As you can imagine, the critical point is to identify the interest rate. But this is critical, not for accounting purposes. Because if you allow your customer to pay 2 years, you need to evaluate the credit risk of your customer. And so the interest rate to be used depends on the credit risk of your customer. The higher the credit risk is, the higher the interest rate is. Is this clear for everybody? But this is difficult for the company because the company is not a bank. Bank, they are structured in order to evaluate the credit risk of their customers. This company products, I don't know, laptop or whatever, plant, machinery. Is this clear for everybody? So, first, we need to compute the present value, so the revenue for sale is equal to the present value of the future payment. And the present value is the future payments, the amount invoiced, multiplied by 1 plus the interest rate. We need to discount for 2 years. So, at the power of minus 2. This is the present value. I repeat again. This amount is equal to the present value, 100,000 euros multiplied by 1 plus the interest rate at the power of minus 2 because we are discounting this amount for 2 years. This is the amount of the revenue. So this means that on January the 1st, year 1, the company has to recognize a revenue for sale equal to 94,259. The same amount is recognized as a trade receivable. Is clear? Your opinion. What does the company have to do at the end of year 1? What is it necessary to do at the end of year 1?
Accumulated interest.
We need to recognize the accrued interest. Okay? So the interest for year 1. Because the trade receivable is recognized on January the 2nd. Now we are at the end of the reporting period. So we need to recognize the accrued interest for 1 year, starting from January the 1st to the end of December. And the accrued interest are equal to the 3%. Of course, January the 2nd, so 1 year. Even if, to be more precise, there will be 364 days. Okay? But it's 1 year for us. 3% applied to the initial amount. So this interest is 3% of the initial amount of the trade receivable, 94,259 euros. Okay? Accrued interest, but these interests are not collected, are only accrued. So we need to recognize the interest expense, interest income for 2,800 and something. Accrued, so this means that the receivable, trade receivable, must be increased for the same amount. The company has the right to obtain another part of money, but the cash will be collected only at the end of year 2. So at the end of year 1, cash is not involved. End of year 2. We need to do the same things for the interest for the second year. And pay attention, how much is the trade receivable in the balance sheet at the end of year 1, sorry. The amount is not 94,259, but the initial amount plus the amount of the accrued interest. So, the amount at the end of year 1 is also the amount at the beginning of year 2. So, the interest for year 2 is the interest applied to the amount of the trade receivable at the end of year 1. So this means 3% of 97,000 and something. 97,000 and something is the amount of trade receivable as at the end of year 1. That is beginning of year 2. Okay? So what about the accounting entry? Is exactly the same if we look at the accounts used, but of course figures are different. How much is the trade receivable at the end of year 2 1 second before collecting the amount. You don't need to do any computation. That we can prove with the computation. How much is the amount of the trade receivable as at the end of year 2, but before collecting the amount due? How much is?
Whole amount.
The whole amount, 100,000. And I can demonstrate this because the amount at the beginning of year 2 is 97, plus the increase for the interest, 100,000. Because we discounted, and the interest income is simply the difference between the initial amount and the final amount. But instead of simply dividing by 2 the interest income, according to this standard, IFRS 9, okay, the right approach is the one that I have just presented. So it is better not to divide simply by 2 the interest income, but taking into account that at the beginning the trade receivable is recognized at 94. So we compute the interest on 94. Then in this way, at the end of the period, the amount of the trade receivable is higher. We compute again the interest, and we obtain the final result. This mechanism is called amortized cost. We will discuss it next week. Just clarify it. Pay attention, please pay attention. Amortize here does not have any relationship with the depreciation or amortization of intangible assets. It's completely another thing. Okay? We will understand why amortize costs, but here simply means dividing. Amortizing, it means dividing here. In fact, this is a way that we have used in order to split, to divide the total interest income over the 2 periods. Is this clear for everybody? So this means that if we prepare balance sheet and income statement, year 1 and year 2. In the income statement year 1, we have the revenue for sale. That is the 94,000 euro. And the trade receivable at the end of year 1 is 97. We have an interest income that is 2,800 in year 1 and 2,900 in year 2. At the end of year 2, of course, the trade receivable is equal to 0 because we collect the full amount. We collect the full amount. We hope, because after 2 years, fingers crossed that our customer is still able to pay all the amount due. It's a very, very risky transaction, this one. Okay? This transaction is put in place by some type of companies, in particular when companies sell very important plant machines, so with an important price, and this is a way of pushing customer to buy. But there is a big risk on the other side. Okay? So bank account and the trade receivable is eliminated. And now the amount of the trade receivable is 100,000, and so we collect 100,000. Is this clear for everybody? Sorry for students at home. I didn't realize that 2 of you answered in the right way to my question about the trade receivable at the end of year 2. It is difficult to look at the same time students here in the classroom and look at the chat. Okay. Any questions? Is everything clear? Because if everything is clear, we have still 2 issues of IFRS 15 that we need to discuss. First one is how to account for contracts where we have many performance obligations. So the step 4. Right now we have always skipped the step 4. And step 4, just to recap, when there is more than one performance obligation in a contract, it is necessary to split the transaction price over the different performance obligations. And generally speaking, this is done according to, or better, on proportion of the so-called standalone selling prices. So here, the problem is that on the one hand, the company presents a single amount of price in a contract, but for many performance obligations. We need to split this price. And according to IFRS 15, it is necessary, first of all, to identify the so-called stand-alone selling price. Stand-alone selling price. So we need to identify the price when the product or the service is sold separately. Now, here in our contract, they are not sold separately. They are sold together. And in many cases, the transaction price is not the sum of the 2 or 3 standalone selling prices. It's different. Okay? So we need to, first of all, to understand the so-called standalone selling price. And the first method, not the first, the preferred method suggested by IFRS 15 is to look at the prices if you sell separately the different products and services. If you don't sell separately the products and services, in this case, the company must estimate the standalone selling price. There are many methods that are possible. First of all, for example, I look in the market, I try to understand if there is someone that is selling separately goods and services, and I look at the prices of the other competitors. Or I can start from the cost, and then I can have a margin. These are again the method that must be used. Only when it is not possible, some other residual approaches are allowed. For your purposes of the exercises, do not worry, we will give you the standalone selling price. But now that you are reading your real consolidated financial statements, for some industry, the step 4 is very important. And if it is important, it is necessary to understand how the company determines the standalone selling prices. Okay? And we do immediately an example. Suppose there is a company that sells together a machine and 2 years of maintenance service. So the company A says, or better, enters into a contract with a customer in order to sell together a machine and 2 years of maintenance. It is quite common that the sale manager tells the customer, do not worry, you pay only the machine. The maintenance is for free. Keep in mind, for free doesn't exist. You pay. Simply, you don't pay explicitly for the maintenance service, but you pay. The maintenance service is included in the transaction price. Is this clear for everybody? Think about this company. It would be a big mistake if this company is not able to understand the standalone selling price of the maintenance. But not for accounting purposes, for its business. Because if its business is selling machine and providing maintenance, the company must know the cost of the production of the machine, the cost for the maintenance service, and so the company has also must be able to determine the price of both the components. This is clear for everybody. It's not accounting. The accounting is the last part. This is business. So, but sales manager, they try to push customers. And so when you buy something, if something is for free, it seems better. But at the end, it's not for free. You simply pay in another form, in another way. So suppose that the price, there is only a price in the contract. The price is for the machine and for the machine. In the contract there is written the 2 years of maintenance are for free. Okay? This is very common. Okay, now suppose that transaction is put in place on January the 2nd, year 1. We need to apply the 5-step model. So step 1, identification of the contract. In this case, just one contract. Okay? Step 2, identification of separate performance obligation. In this case, we have 2 performance obligations. We have the performance obligation sale of the machine, and we have the performance obligation maintenance service. 2 years of maintenance service. Is this clear for everybody? Okay. I didn't give you the amount of the contract. The total amount is 1,100,000. Okay? So step 3, determination of the transaction price. In this case, suppose that the amount is paid in 60 days. If the amount is paid in 60 days, we don't have any problem of financing component, okay? Because the delay is less than 1 year, so we don't have any problem. The price is fixed. There are no rebates, no discount, no return rights, nothing. Okay? So step 3, we have a fixed price, no significant component, financing component. So the transaction price is 1,100,000. Okay? Now, step 4, allocation of the transaction price to the 2 performance obligations. We need to know the standalone selling price of the machine. So we need to understand the price at which the company sells the machine when the machine is sold separately. We know to understand, to determine better the standalone selling price of 2 years of maintenance service when the maintenance service is sold separately. And if we suppose that our company sells separately the machine and the 2 years maintenance service, it is very, very easy to determine the standalone selling price because we know. Okay? So we have machine and the 2 years maintenance service. We need to find the standalone selling price. I repeat, the standalone selling price is the price that the company would offer to the customer if the product were sold, the product and the service were sold separately. And suppose, for example, 850,000 for the machine and 350,000 for the 2 years maintenance service. Is this clear for everybody? Look at the transaction price and look at the total. If the products and the service were sold separately, the price would be 1.2 million. Since in the contract the machine and the maintenance are sold together, the price is a little bit lower. So at the end there is a sort of discount. Okay? The IFRS 15 requires to allocate the transaction price based on the proportion of the standalone selling price. So we need to compute the proportion of the machine price, 71%, and the 2 years maintenance service. So, if sold separately, the machine would be sold at 850,000 and the maintenance at 350,000 for a total amount of 1.2 million. So the weight of the machine is 71%, 850,000 out of 1.2 million. The maintenance service, the remaining part. So this is the proportion of the stand-alone selling price. Stand-alone selling price. Is this clear? Now we use this percentage in order to make the allocation. So since the transaction price is 1,100,000, if we apply the percentage of 71%, we obtain the part of the transaction price that is for the sale of the machine. If we apply 29% of percentage to the transaction price, we obtain the part of the transaction price to be allocated to the 2-year service. Of course, the sum is 1,100,000 euros. Is this clear to everybody? Step 5, recognition of revenue. Keep in mind, revenue is recognized when control is transferred and it is possible to transfer the control at the point in time and over time. What about the sale of the machine? At the point in time or over time? At the point in time, we don't have any other information, and so we suppose that it's on January the 2nd, since we don't have any other information. 2 years of maintenance service. At the point in time or over time? Over time. Then the critical point is how to split. Because it depends on the experience. Sometimes the maintenance service is for activities done mainly in the first month of use. Some other times it's at the end of the period. In other industry could be evenly distributed. So it depends. For our exercises, we can simply divide it by 2 years. Okay? But keep in mind that in real situation, it is necessary to verify when we expect. Sometimes it is possible to define exactly when the maintenance is provided. Okay? Otherwise, if there are a lot of small contracts, the company has to make estimate again based on the experience. Okay? So this means that if the revenue for 2 years of maintenance is 320,000 euros per 2 years, so the annual revenue for maintenance, for the service of maintenance, is 150. Is this clear for everybody? Now, we have all the data in order to make the accounting entries and to draw up the financial statements. January the 1st, year 1. I accept suggestions for the accounting entry. I accept suggestions for the accounting entry. I wait for suggestion. This morning I had a lecture, but in that type of class I have a list with the name of all the students, and when there are no volunteers, I call a student from the list. Here I don't have a list, or better, I have the list of the students that are at home, but I don't want to push students that are at home, but thank you, Emanuele. We start, first of all, by recognizing the revenue of the machine. Okay, this is a possible starting point. Revenue of the machine. Credit side. And the revenue is for 79,000 and something. Keep in mind that in the invoice there is written 1,100,000 euros. And the full amount is collected in 60 days, for example.
Trade receivable.
So we need to recognize also the trade receivable. For what amount?
The total.
110,000.
110,000.
1,100,000 because the company invoices everything and in 60 days everything is collected. As you can see, there is a difference between the amount recognized in the invoice and the amount recognized as a revenue.
It's the maintenance service.
Any idea?
The maintenance?
Sorry?
The maintenance service.
This is the maintenance, but we cannot recognize these amounts as a revenue because the revenue of the maintenance must be split over 2 years. Okay? So on January the 1st, we cannot write maintenance revenue for maintenance because the control is not yet transferred. These 320,000 euros must be divided over 2 years. If this company is listed and has to present the quarterly report, for example, for the first 3 months, only 3 months of maintenance must be disclosed. Okay? It is possible to obtain the final result in different ways. Now, I propose you accounting entries that are very linked to the IFRS 15, and in particular that can help you in managing all the different situations of revenue recognition. If an amount cannot be recognized as a revenue, it is
Again.
no. Revenue gain is the same. If it is not a revenue, you have 2 possibilities. You used one of these possibilities this morning. But the second possibility is the one written by Emanuele. It's a liability. A contract liability. Or, if you prefer, but at the end it's always a liability, if this is not a revenue of year of if it is not a revenue to be recognized on January the 2nd, this is a revenue that must be deferred. Okay? So, if you want, deferred revenue. Deferred revenue, at the end, it's a liability. For Italian students, but also for foreign students, if you stay here in Italy, probably it is worth knowing also the name in Italian. Deferred revenue are risconti passivi. Risconti passivi at the end are a liability. Okay? Or if you want, Valentina, it's the same unearned revenue. But I prefer contract liability or liability for deferred revenue because if you read the IFRS 15, you don't find neither deferred revenue nor unearned revenue, but always contract liability. But at the end, for our purposes, it's exactly the same. What is important is that this amount is a liability. Then, at the end of December, year 1, Or if this company is a medium or big company, it is highly probable that the company does not wait for the end of the period in order to recognize the revenue for service. But at the end of each month, part of the revenue is recognized in order to be able to have always the situation under control. Is this clear for everybody? In our exercises, our goal is financial statements for the year. But if we are the CEO of the company, we want to know at the end of each month how much is the amount of revenue for the maintenance service. But our purpose is, it's enough once a year. We need to decrease the contract liability, or if you prefer, the deferred revenue, and we need to recognize 1 year of revenue for the maintenance service. So 1 year is 160,000, and we decrease the deferred revenue for the same amount. The same at the end of year 2. Deferred revenue for maintenance service. And of course, in this way, at the end of year 2, in the balance sheet, how much is the amount of the contract liability? Zero, because we are at the end of the period. Is this clear for everybody? So we have balance sheet and income statement. In the income statement, we have the revenue for the machine and the revenue for maintenance. Year 1 and year 2. The revenue from the machine is recognized immediately. The revenue for the maintenance service is recognized at the end of year 1 and at the end of year 2. And in the balance sheet, right side, we have the contract liability. That is equal to 160 at the end of year 1 and 0 at the end of year 2. Trade receivable is 0. I didn't make the double entry record, but it is paid after 60 days, so it is 0. Of course, if we look at cash or bank account, if you prefer, we don't know exactly the initial amount of the bank account, but we know that the company has collected the full amount. This means that in the cash flow statement. Operating activity. Year 1. Proceeds from customer. The whole amount collected in year 1. Of course, 0 in year 2. Even if the part of the obligation is satisfied only in year 2. Is this clear for everybody? Any questions? This is just an example of a contract with many performance obligations. In the slide, at the end of the slide, there is another example . There is another example in the telecommunication industry. Look, this is another industry where it is very, very common to have contracts with many performance obligations. There is an operator that proposes 2 contracts. You can buy a mobile phone only for 90 euros, but if in the meantime you enter into a mobile service for 12 months for 100 euros per month. Step 1. There are 2 contracts, but for accounting purposes, we need to account for them together. Because you pay 90 euros for the mobile phone if and only if you sign also the other contracts. Combination of contracts. Okay? So there are 2 performance obligations. What about the transaction price? 90 euros plus 100 euros per month for 1 year. So the total is 1,290. But what about the standalone selling price of the mobile phone? It is not 90 euros, but 300 euros. What about the standalone selling price for the mobile service? In this case, 100 euros per month. So, if the company sells separately the mobile phone and the service, the total standalone selling prices would be 1,500 euros. So this means that the percentage for the phone is 20% and the percentage for the service is 80%. Do you agree? So this means that since the transaction price is 1,290, this must be split into 2 parts. Okay? 20% for the mobile phone, 80% for the services. What is the difference? The phone, the sale of the phone must be recognized at the point in time when the phone is delivered to the customer. The service, the mobile service, must be recognized over time, over 12 months. If the total amount is 1,032 euros, this means 86 euros per month. Is this clear? I strongly suggest you to have a look for tomorrow afternoon at the following slides, where there is the balance sheet and the income statement. Okay? It's exactly the application of what we have done, but it's a little bit different because in this case, the amount collected at the beginning is less than the revenue recognized in the income statement. So please have a look at the slides with the solution of the balance sheet income statement. And tomorrow afternoon, if something is not clear, we can discuss example. Okay? Because here you have all the data in order to draw up balance sheet and income statement. Okay? You deserve a break of 20 minutes. And this is the balance sheet and the income statement. Okay? In the cash flow statement, we disclose only the cash in and cash out. So, of course, the balance is that at the end we have the operating activity, the financing activity, the investing activity. We have a decrease or increase in the cash from the beginning, and so it is balanced in this way. Okay? Thank you. You're welcome.
Io le chiedo una cosa molto veloce. Questi numeri qua, per cui li abbiamo trovati, e tu lo puoi fare 71% di 1900 ma non mi escono più alti. Ok.
Qui bisogna fare 150 poco visto.
Ok, grazie.
Cioè, giuro, veramente mi fumava il cervello a un certo punto. Non per scrivere. La parte peggiore.
Adesso sto... vai tranquilla. Non è che mi faccio la famiglia.
sacchi, no? Ma soprattutto fate respirare.
Hai scoperto
in giro.
Sì, stavo solo aspettando la ragazza di Torino che mi ha chiesto di guardare il computer e ho detto magari faccio un contatto. Ci metti poco per Pasqua. Ho scoperto perché io ho preso le percentuali direttamente dei brevetti che sono arrotondate. Ma 70 perché sì? Perché vedi una 29 data che 71.
Come si potrebbe vedere, effettivamente 16 minuti fa sul 110.
Sì. Perché io lo guardavo e dicevo, io va bene, non si fa, va bene, quindi tecnicamente se faccio 850.000 diviso 1.200.000 potrebbe uscirmi 70, no scherzo, 0,703.
Quindi alla fine non c'è nessuno, non riusciamo mai a dire ci sto.
Ma anche io, secondo me fate capite anche di cosa inizio a segnarvi le cose che sono divente a caso perché.
E anche in questo senso,
Però non vuoi
essere. No, però c'è troppo che dobbiamo farlo. 3 giorni.
Siamo partiti che mi sembrava tutto stupido, mi sembrava roba fatta.
Vero?
Fatta. Siamo finiti che invece fa schifo in quantità e già che era transfer che mi sta molestando da 3 ore e mezza. No,
L'ho presa.
Ivan, tu resti qua, adesso esci.
Sì, come controllo
No, non è mio in realtà, è della ragazza accanto a te che non mi ricordo come si chiama.
Elisa.
Però
Elisa.
l'altra ragazza cinese accanto ha lasciato anche l'iPhone.
Lei non è cinese.
Lei è Enrica.
Ah, Enrica! Scusa, pensavo fosse la ragazza
Bionda.
la confusa per quella accanto a me.
No, ma sì,
Enrica, avevo rinfatto il meglio veloce, però.
Guarda quanto che rubice.
No, lei è estremamente fiduciosa, hai lasciato lì proprio tutto, hai detto se entrano, prendono.
Sì, io ci ho messo i pelli sopra, ma
Sì, abbastanza
ci ho
tranquillo.
provato.
Sei abbastanza tranquilla. Se non mi rovano tutto poi mi pento, però.
Poi non lo sarai più.
Prima quando
Forse è quello che noi siamo già stati.
del violento. Perché a me il libro
Non so. Il libro non ti fa niente.
infatti dicevo, penso di venderlo.
Io fine abbiamo le serve. Ma questi libri sono.
Non so,
Mi faccio i soldi.
queste cose così. Ma poi si vede sempre negli esercizi quello che vogliono facciamo. Magari non è così. Poi facendo gli esercizi capisce meglio adesso poi non lo fai te praticamente, quindi non è che capisci molto. Però. Io sì.
Io sto provando a mandarmi, sono andata a chiedere una cosa ma ho fatto sbagliato, non sto facendo niente.
Che cosa che fate?
Perché la dichiarazione del lavoro indipendente,
Ah, Lise.
sì, però io ho messo di una rendita, detrazioni, e mi metto che se invece se hai un lavoro ok, invece non hai un lavoro devi metterlo in base al reddito, come se tu con un unico reddito avessi questi soldi. Tu mi scusi, non è tanto.
Che ho chiamato perché ho capito che serviva e se io siccome ho lavorato devo chiedere se le detrazioni me le hanno già messe per quello oppure no, perché se non me le hanno messe allora devo dire loro di mettermele. Tu quindi non hai altri redditi oltre a quello, oltre a questo.
Ma cosa vuol dire? Cioè, in questo stato lavorato. Quindi non
Però
è-
avevi un contratto regolare o in nero?
non è regolare.
Allora tu devi mettere che hai lavorato e tu hai tipo un commercialista, un capo,
Sì.
ecco allora devi andare a chiedere a lui e come fare.
Cioè io vorrei questo.
Anch'io però ce li dobbiamo sudare.
Sì, veramente.
A casa ci sono pure le tasse sulla borsa di studio.
No, veramente?
Sì.
Oh Maria.
Ma voi siete fatti per
Lei ha detto le 5.
le 5, io c'era scritto 5 e mezzo.
No, perché forse voglio lasciare spazio per chiedere domande.
Io no.
Anch'io.
Perché non ho conferenza? Faccio bene, non so, io vorrei chiederti queste cosa. Questa è la teoria, però adesso la pratica. Perché tra l'altro scusami, lui mi ha detto, mi fai guardare tutta la guida che ho chiamato io per guidarlo.
O l'ho mandata adesso.
Allora è
È arrivato adesso?
no, no, è arrivata ieri alle 14:57, però non l'ho vista.
per le prime barriere.
Sì, ho visto,
Esercizio, qualcuno che tutto chiaro. Sì, ma è come statistica, generazione non capivi niente, poi c'è tutto per capire. Non tutto, però dicevo 1000 volte più facile la teoria, c'era proprio quella non capivo nulla.
La serie tu dicevi pure.
Sì.
Come c'è alla fine sì, questo esercizio quello per te
Sì.
Quindi la consistenza è stata di quanto?
Quello di poca.
I meno sono il 20%.
Eh? E poi di meno.
No, come il 20%. No. Però non ho fatto una schietta.
Cosa?
C'è l'ex previamente. Devi vedere il nulla, non la penso.
Chi? Ma lei si è già laureata? Non so.
L'ho chiesto, mi piace da dire. No, ma io non posso dire. Sì, però
Solo i voti più alti.
e poi devi farlo, devi avere un anno, alla fine dell'anno scolastico devi avere finito tutti gli esami.
Magari lei se non si lavorato da prima non l'hanno considerato. Perfetto.
Veramente,
Sì.
ti lauri prima per uno scherzo.
Mi sa che per quello. Perché se aveva la media, quanto aveva la media? 29?
Almeno probabilmente
29? Quindi sarebbe entrata sicuro per la lista.
sicuro sì.
Probabilmente no, siccome era da prima non ho considerato.
Li avrai prima.
Ehi.
Sai che arrivo tardi.
Vuoi trasferirti quanto costa?
Sono pieno di roba.
Non si capisce la lingua perché loro parlano massimo spagnolo. Sono tutto bene, sì, inglese è vero. Io non ho mai sentito un portoghese parlare inglese. Perché sbaglio? Quando vai in Spagna mi parli in italiano, loro fanno benissimo.
哦，我还以为他会停，居然没停。
就这样一直在录。妈呀！我觉得今天的还是很容易的，要比之前的要简单的多的。
好理解一点。
对，
对。
即使它计算的东西比较多，但其实还是更容易一些。
我觉得今天的是怎么样？
很简单。
是我今天也听懂了。
因为今天的我觉得就。
他今天是按照那个步骤来的，就本来就比较顺一点，然后就又做了很多这种这个。
妈的，我要打他了，还不通过我的 ins。
你问了没呀？
没呀。
你得问呀。我觉得他就忘了已经。
Okay. I hope ready again to start. I would like to discuss with you a last example of relative recognition. A particular situation, but it is an important situation. That is when there are contracts to construct, let me say, complex assets like dams or pipelines or very complex buildings and so on. As you can imagine, again, it's something that for I don't know, for Carrefour, for Auchan, is not material. It's not so material neither for Eni and for British Petroleum, but it is important for other type of companies. Okay? Here the problem is that it is quite common that in order to construct this type of assets, the time required is a very long period of time in terms of years. And this means that generally speaking, in this type of situations, the revenue is recognized over time because of the peculiarities of these contracts. But this is not like a mobile service or like a maintenance service. This is completely different. Here the company constructs an asset, a complex asset, a plant for example, but then it is used by the customer. It's different compared to a maintenance service or a telecommunication service. So here the problem is how to split slide 19, the revenue over time. So we know that for this type of contract, that is contract for construction of assets, that doesn't have an alternative use. A dam is a dam. A pipeline can be used only by the buyer. In most of the cases, the customer is a government. So there are no alternative use. If the customer decide that I'm no longer interested in the dam, you cannot sell the dam to someone else. Is this clear? The key point. And this is also in this type of contract, generally speaking, the company has the right to be paid for the work performed up to date. So if the customer decides that he is no longer interested in the asset, I want to be paid for the work done up to date, because I don't know what to do with the dam that is a work in progress. I cannot sell. It is not mine. Okay? It's not like a car. If a customer orders a car, then the customer changes idea. For the car maker, it is not a problem, because the car is sold to another customer. For the dam, for the pipelines and so on, it is not possible. So the revenue is recognized over time. But the key point is how to split the revenue over time. Keep in mind that the revenue must be recognized when the performance obligation is satisfied. Here, the performance obligation is satisfied little by little, step by step, over time. But we need to find a ways in order to split the revenue. Generally speaking, there are two methods: output method and input method. The problem is that output methods, they work, for example, for cleaning services. In terms of hours, for example. I have a contract in order to provide, 200 hours of cleaning services. And so, output the hours performed. But here, the result is a building. It is difficult to measure the output. The customer is interested in the final building. Okay? So it is quite common, even if it is not the only possibility, but to use input methods in order to recognize the revenue over time. There are a lot of input methods, but the most common input method is the so-called cost-to-cost method. Okay? This is very, very common method. The assumption is that the percentage of cost incurred up to date is a proxy of the performance obligation performed. To be more precise, it's a proxy of the satisfaction of the performance obligation. But the costs are the inputs. So this is why an input method. I'll give you an example. Suppose that the company has a contract in order to construct a very complex asset. The transaction price, the consideration, suppose is 10 million. In this exercise, generally speaking, in our exercise of this type, the transaction price is fixed. But in this type of contract, it is very common heavy variable price in terms of bonuses and penalties. These contracts are complex because it is quite common that after some months the customer changes idea oh no, I don't want the pipeline exactly there, here, but I want the pipeline there, so I want a change. So there are a lot of changes that can affect the contract, the consideration, and so the accounting. For our purposes, do not worry, but if you read financial statements of a company that is involved in this type of transaction, be careful, because it's quite common to have a lot of variable prices that can affect, and so the revenue is subject to the estimates, but not in terms of return rights or rebates. Here we are talking of an important amount of the revenue recognized in the income statement. Suppose that the total expected cost are equal to 8 million. Okay? This is an estimate that the company must do at the beginning, not again for accounting purposes, but if I'm not able to estimate the total cost of the asset, I cannot neither negotiate the transaction price. Is this clear for everybody? So it's an estimate that is always done. Otherwise, it is not possible to negotiate with the customer the price. This is the total expected cost. And suppose that during year 1, the company incurs in 5 million euros of cost and 3 million in year 2. Again, this is another big simplification. Because as you can imagine, the initial estimate of the cost is never confirmed. It could be lower than the actual cost, that could be lower or higher. Unfortunately, in most of the cases, the actual costs are higher than the expected cost in this type of business. Okay? In our example, the estimate is confirmed. 5 million in year 1, 3 million in year 2. So the total cost is exactly 8 million. Cost to cost method. Cost to cost method means that we compare the cost incurred up to date to the total expected cost. For example, for year 1, 5 million is the amount of cost incurred up to the end of the year 1. The estimate of the total cost is 8 million. So this means that the percentage of the so-called stage of completion is 62.5%. This is the stage of completion as at the end of year 1. This stage of completion is estimated using the cost-to-cost method. Okay? I repeat, this is not the only way of estimating the stage of completion, but it's the most used in case of the construction industry. At the end of the second year, the stage of completion is 100%. because the company has incurred in 5 million in year 1, 3 million in year 2, and since our estimate at the end has been confirmed, of course, the stage of completion is 100%. The asset is completed. Is this clear for everybody? So this means that in the income statement, year 1 and year 2, revenue and cost. Costs, of course, are the costs incurred. And in our particular example, 5 million and 3 million exactly as expected. It never happens in real situations. Okay? Never. It's impossible. Revenue. How much is the revenue to be recognized in year 1 if the stage of completion is 62.5%? If 62.5% of the transaction price. Since the transaction price is 10 million, using the cost-to-cost method as a proxy of the satisfaction of the performance obligation, we are saying that the performance obligation is satisfied for 62.5%, and if the performance obligation is satisfied for 62.5%, this means that we can recognize the 62.5% of the transaction price as a revenue in year 1. Is this clear for everybody? What about year 2? In this case, it is easy because this is the last year. Okay? So you can determine the amount in many ways, but we can use the difference between the stage of completion at the end of year 2, the stage of completion at the beginning of year 2, of course multiplied by the transaction price. Okay? When you make the exercises, pay attention that at the end, the sum of the revenue recognized in year 1 and 2, or if the construction lasts for more than 2 years, in year 1, 2, 3, 4, I don't know, 5, the total amount of revenue recognized must be equal to the transaction price. Otherwise, there is some mistakes. Okay? And cost, of course, the sum of the cost is exactly the sum of the actual cost. This means that, as you can see, that the margin, the 2 millions of margin, are divided into the 2 years according to the stage of completion. The stage of completion is measured according to the cost to cost. It is clear for everybody? But there is a little complication. What about the money collected? I mean, this is the depiction of the income statement. If you were this company, you would like to be paid during the work. You don't want to wait for the end of the project, because these contracts are for a huge amount of money. You need to pay suppliers, you need to pay employees, and so on. So it is quite common, okay, to require the customer to pay during the construction period. So, different scenario. Scenario A, cash collected in year 1, 6,250,000. And this scenario, and cash collected in year 2, of course the difference between total transaction price and the amount collected in the previous year. Is this clear for everybody? So, in the balance sheet, here, pay attention. The income statement is the income statement that I have just presented. Revenue and cost. Now the problem is in the balance sheet. Okay? Think about the, if you want, think about the accounting entry, or think about your rights and obligations. How much is the amount of the revenue recognized in year 1? 6,250,000. How much is the amount collected? 6,250,000. Do you have any other rights toward your customer? For the work completed, I mean? Because, of course, you have the right to be paid for the remaining part. But the problem is that the remaining part is not performed in year 1. The work that you have performed is 6.25, and you have obtained exactly 6.25. So this means that in this case, contract assets, 0. You don't have any other rights toward your customer. And, or if you prefer, instead of contract assets, amount due by the customer. The customer does not have any other obligations because the customer has paid exactly the amount that you have performed and recognized in the income statement. But in the meantime, contract liability, or if you prefer, amount due to the customer, again, 0. You don't have any obligation towards your customer, of course. You have the obligation to finish the project, but this is something that must be done in year 2. Is this clear for everybody? Here, in the scenario A, the amount collected is exactly equal to the amount recognized in the income statement. So the company does not have neither any rights towards the customer nor any obligations. But, so this is the scenario A. And this is always year 1. Now look at the scenario B. Suppose that during year 1, your customer pays 6 million. This means that the other 4 millions will be paid in year 2. Okay? But the income statement is always the same, because revenue and cost do not depend on the money collected. Accrual basis. The revenue must be recognized for 6,250,000 because the stage of completion is 62.5%, irrespective of the money collected. But if you recognize 6.25 million in the income statement, but your customer has paid only 6 million, how much is the amount due by the customer? 250,000. So this is a contract asset, because this is the difference between the revenue recognized in the income statement and the amount collected. You have performed the project, the work, for a total amount of 6,250,000, but you have received only 6 million. So this means that the customer must pay another 250,000. That is not collected in year 1, but is going to be collected in year 2. So at the end of year 1, the company has the right to obtain another 250. Is this clear? Look now scenario C. Suppose that in year 1, the company collects 6,600,000. So, of course, this means that the other 3,400,000 will be collected in year 2. So, the company has recognized in the income statement always 6,250,000. But in this case, the company has collected 6.6 million. So an amount that is higher, greater than the work performed. So, of course, the customer does not have any other obligation to pay. The problem is the opposite, is that since the company has collected 6.6 million, but in the income statements, the revenue is recognized only for 6,250,000. This means that there is a contract liability, an amount of money collected in advance. Is this clear for everybody? Of course, this amount is due to the customer, but we hope that everything will go in the right way in year 2. So we simply perform our job. We don't need to pay back anything to the customer. We will finish our task. We will finish the dam, the pipelines or whatever, in year 2. But we have collected an amount of money that is higher compared to the revenue recognized in the income statement. This approach at the end is the same that you have to use in order to understand the example of the telecommunication company. Exactly the same approach. Is this clear for everybody? Any questions? Okay, in this way, we have analyzed the variable transaction price, rebates and return rights. We have analyzed the presence of the significant financing component. We have discussed how to split the transaction price over many performance obligations, and with this last example, we have also understood how to apply the cost-to-cost method in order to split the revenue over time. Now, more or less, you have the basics of IFRS 15 that allow you to read more or less financial statements of all types of industries. And in particular, this is FCA financial statement. FCA financial statement, the income statement is page 198. Net revenues, 86.6 billion euros. If we go to page 270, here you can see the description of the revenue recognition. There is a first part that is a general part. FCA says vehicles, services, and spare parts. As you can see, we can read here performance obligations. Performance obligation is the word used by IFRS 15. Read here the timing of when FCA transferred the goods or services could differ from the timing of the customer payments. FCA recognizes a contract liability when it invoiced an amount to a customer prior to the transfer of goods or services provided. Because if goods and services are not transferred, this means that the revenue cannot be recognized. Contract liability. Right to return. And as you can see, returns are estimated based on the historical experience. And here, contract with multiple performance obligations. In this case, step 4, the transaction price must be split according to the standalone selling price basis, and the standalone is the observable price, or when it is not possible, the approach used is the cost plus margin. As you can see, these words are not FCA specific. These words are the words used by IFRS 15 that then are used by FCA, ESA, Carrefour, Auchan, and so on in order to describe the revenue recognition. Then there is a part that is specific for sale of goods, a part that is specific for services, and contract revenues are contract assets like the one that we have just discussed. But you can see also from the sentences used that for FCA are less significant compared to the sale of goods and services provided. I would like to highlight only few parts. Here, FCA is describing the revenue recognition of sales of goods. And as you can see, transfer of control and therefore revenue recognition corresponded to the date when the vehicles or service parts were made available to the customer, or in some other contracts, when the vehicles or services were released to the carrier for transportation. But they are different, these two dates, okay? Because suppose a car that is manufactured in Turin. Suppose that the dealer is, I don't know, in Rome. When if they are the control is transferred when the car is available for the customer, this means when the car is in Rome at dealer's premises. In other contracts, it's when the cars are released to the carrier. So from Turin to Rome, maybe it takes 2 days. So it is not the same if of course, don't think about a move here. Think about the quarter, the semi-annual report. So it is completely different. Okay? So it is necessary to read carefully the contract with the customer in order to understand when the customer obtains the control over the cars. Okay? Is this clear for everybody? Then there is a lot of there are other disclosures. You can have a look at them, and I ask you to read disclosure in the notes of your financial statement, the financial statement of your project work, in order to understand if there are some peculiarities about revenue recognition. As you can imagine, it's not the same for the car makers or for distributors of goods or for a pharmaceutical company or for other type of companies, okay? For car makers, the revenue recognition could be difficult, and this is why there are a lot of sentences dedicated to disclose this part. Okay? Any questions? Is everything clear, or I hope, or probably it's the fact that it's 5 o'clock in the afternoon, so even if it is not clear, probably it's too late. I would like to introduce now another topic that we will discuss in detail tomorrow, but I would like at least to introduce, and in particular, business combination. So now we are going to understand when and for which amount goodwill is recognized in financial statement. Okay, so business combination, and then the consolidated financial statements and so on, but we'll start with the goodwill and business combination. The standard is IFRS 3. Okay? We need to analyze a lot of things, but we start immediately with the definition of business combination. Read the definition. Business combination is a transaction or another event or in which an acquirer obtains control of one or more businesses. A business is not just a group of assets, but it's an entity. A company is, for example, a business is a company that manufactures cars, a company that provides services. So when we say business, it's not simply three assets that are sold together, acquired together. That's something more complex. You are acquiring an entity. There are a lot of ways of putting in place business combination, a lot of ways. The easy way is to buy a business and to pay cash. But it is possible also to buy the shares of another company. Or you can merge another company. Different ways of obtaining the same result. Before the business combination, the business acquired, that is the acquiree, was controlled by the seller. After the business combination, the control over the acquiree is of the acquirer. Is this clear for everybody? If I'm not wrong, last year, so in 2020, I got red, okay? Here, Intesa San Paolo is the most important Italian bank, acquired control over another important bank that was UBI. Okay? But this acquisition was done through a merge at the end. So today, UBI no longer exists, because today all the activity of UBI are merged within Intesa San Paolo. Is this clear for everybody? Some years, this spring, in 2021, I erased everything, okay? Moncler acquired the shares of a company that owns the brand Stone Island. Okay? Again, it's a business combination, but performed in another way, because the company acquired still exists as a separate legal entity, but Moncler now controls this other company. In the case of Intesa San Paolo and UBI now no longer exists as a separate legal entity. So the message is that there are a lot of ways of making business combination. Business combination is the accounting name for merger and acquisition, M&A. Is this clear for everybody? And it is important to know how M&A, to be more precise, business combination, are accounted for in financial statements under IFRS. And the acquisition method must be applied. There are no other possibilities but only the acquisition method. In order to apply the acquisition method, it is necessary to follow a procedure in different steps. First one, we need to identify who buys who, so the acquirer. We need to identify the acquisition date. Then we need to understand the assets and the liabilities acquired, to understand what type of assets and to measure them. Eventually, we need to verify if there is a goodwill. But start from the beginning. The acquirer. Most of the cases is very easy. Intesa Sanpaolo merged UBI. UBI no longer exists. Intesa Sanpaolo is still there. So Intesa Sanpaolo is the acquirer. UBI is the acquiree. Moncler bought the shares of the company that holds Stone Islands. Moncler owns the shares. Moncler is the acquirer. But PSA, FCA, they announced and then they put in place to merge. Nowadays, neither FCA nor PSA exist, because now we have Stellantis. But for an accounting purpose, it is necessary to understand who is the acquirer, FCA or PSA. Please, for tomorrow afternoon, read the notes of both of the companies, because the description is the same. Even if the financial statements are financial statements of 2020, it is well described the acquisition. Because here in Turin, they told us that the merge is a merge of peers at the same level. For accounting purposes, it doesn't exist. Is this clear? There is someone that buys someone else. For tomorrow afternoon, read the notes, and then in this way we will be able to understand the acquirer and the acquiree. The date of acquisition of control, the acquisition date. Again, in our exercises, it will be very, very easy. We will provide you the acquisition date. And in most of the cases in our exercise, the acquisition date is the beginning or the end of the period. But as you can imagine, acquisitions can be done at every point in the year. So it is important to understand when the control changes. So when the control passes from the seller to the acquirer. This date is very, very, very important because this date is used. So if this is the acquisition date, October the 7th, this is important because from the acquired point of view, the acquisition is effective starting from this date. So we need to understand assets and liabilities acquired, and we need to determine them at the acquisition date. Not one day before, not one day after, exactly at the acquisition date. And the same for other less relevant topics for you, but very important for complex acquisition. Okay? So the acquisition date is very, very important because for the acquired, the accounting for is done at the acquisition date. And I repeat again, it's not one day before, it's not one day after. We need to verify the composition of the acquiree at the acquisition date. Okay? And the last phase, third step, at the acquisition date, Intesa San Paolo was obliged to identify all the assets and all the liabilities of UBI. So, if I obtain the control of another company, another business today, I need, first of all, to verify what I have just bought in terms of assets and in terms of liabilities. And I need to recognize in my accounting books the assets and the liabilities both. But at the acquisition date, assets and liabilities acquired must be recognized at their fair value at the acquisition date. So it doesn't matter the amount shown in the balance sheet of the acquiree. It doesn't matter. The acquirer needs to verify, to determine all the assets, all the liabilities, and has to measure them at their fair value, market value, at the acquisition date. This activity is called purchase price allocation, PPA. And it is very important for the acquirer, very complex, time consuming. So it is highly probable that the acquirer asks for an advice. So this is business for consultants that help the company in order to perform the purchase price allocation. But we will start the analysis of the purchase price allocation tomorrow afternoon. Okay? I don't know if you have any questions. I kindly remind you to book for the exam. It was my fault today. I wrote 13th of November, but of course, if the exam is scheduled for 15th of October, please, by next Wednesday, book on Moodle. It is very, very important for us in order to manage the classroom, to print the copies of the text, and in order to prepare also the online exam. Okay?